DeFi is the contraction of decentralized finance, and it's the idea of creating financial products using the blockchain. And the blockchain helps abstracting trust and middlemen so that you can create a more transparent and accessible finance. FX protocol is a protocol that offers two main products. The easiest one is a stablecoin yield strategy. So it's just like a savings account on the blockchain, earning yield USD denominated. And the main thing is that it's organic and sustainable yield. I'm Cyrille and I contribute to DeFi projects. History has shown that lack of transparency in finance leads to catastrophes such as the 2008 subprime crisis and stuff like that. At the end of the day, it mostly leads to regular people losing money they actually need because they have no access to the data. I lost pretty much everything after in 2018, but I got to understand a bit of what crypto were. I wanted to learn how they could generate that kind of yields, and this is how I got into DeFi. And I realized by doing actual DeFi, I could abstract one middleman and actually understand and be responsible for the risk I take. I've been following Aladdin DAO since the first protocol Aladdin built. And when I heard about the latest one, which is FXUSD protocol, I had ideas that I just shared on the Discord. And the team at the moment said, oh yeah, that's a good idea. Why don't you do it? And I did. The main difference is that you don't need to trust anyone to hold to the assets backing your stablecoin. You just have to trust the code, and the code is massively audited. We build things differently and we build transparent and fair thing for users. With FXUSD, it's about building some zero stress leverage and sustainable decentralized yield strategy. And there's nothing else like that in DeFi.
Hey, When Shift Happens family. Welcome to Drops, a podcast series where we showcase smaller rising star projects in the crypto space. Since When Shift Happens started to take off, we've received hundreds of requests from many great projects every month that we had to say no to because they weren't a good fit yet in terms of size and impact. But this has now changed with the Drops podcast series. We're building When Shift Happens, the most credible platform in crypto. And there is no reason why smaller projects with big potential shouldn't have a chance to be heard. Drops is not a research service nor an endorsement, but a way to give a voice to the potential big crypto founders of tomorrow. If you had to explain what it is you do and why you do it to someone who's never heard of Web3 or DeFi, what would you say?
Okay, so I'm Cyrille and I contribute to DeFi projects. So let's maybe explain what DeFi is. DeFi is the contraction of decentralized finance, and it's the idea of creating financial products using the blockchain. And the blockchain helps abstracting trust and middlemen so that you can create a more transparent and accessible finance, basically. And that's the purpose of doing DeFi. And yeah.
Why is that important?
Because I believe history has shown that lack of transparency in finance leads to catastrophes such as the 2008 subprime crisis and stuff like that. And it at the end of the day, it mostly leads to regular people losing money they actually need because they have no access to the data. And even if they had access, they wouldn't even understand it in the first place. And so, yeah, I believe transparency in finance can change a lot of things in the world. And this is what I like about DeFi.
Who are you?
Who I am? I'm just a random dude living in France, passionate about tech and values like the ones blockchain and DeFi share. And yeah, that's it. I just popped up in a Discord channels, which is like a social media, and shared ideas and was asked to contribute to the project.
You said I'm just a French dude.
Yeah.
Passionate by tech. Yeah. How did you go from tech to crypto?
I get, in my opinion, crypto is some kind of a nerdy stuff in the first place. So since I've always been a nerd, I learned about crypto maybe in 2012 or something like that, while I was a student. I finally started buying random stuff in 2017, learned about volatility, and was quite impressed with the bull run at that time. I lost pretty much everything after in 2018, but I I got to understand a bit of what crypto were. While in the first place, it was when I first heard about it, it was very wasn't very tangible to me, and I finally understood what it was. But I took some distance of the markets because of volatility. I realized that as an investor, I wasn't comfortable with volatility, which may sound crazy since I work in the crypto industry now, but in the first place, I wasn't very comfortable. So I did other kind of investments, and I focused on building, working in different fields. And I went back to crypto and to DeFi to generate yields on my fiat currencies or stablecoins, whatever. Because I figured you can generate very attractive yields in DeFi, obviously with different risks, but more tangible risk as long as you understand what's going on, and very attractive yields. And this is how I got back to crypto through DeFi, and over time learned to expose myself more on volatility.
When was that?
2020.
What are the protocols or companies that kind of sparked your interest into this beautiful world of yields?
In the DeFi summer, I guess it was mostly Aave, the Curve ecosystem in back in the days, and a lot of small stuff that I could see as mistakes, but also as teaching mistakes in the days. Like in the DeFi summer, you could get some crazy 1,000% yields, obviously that couldn't last, that most of them were Ponzi schemes. But I tried, I learned, I earned in some cases, and I lost money in other cases.
You mentioned also Celsius, BlockFi.
Nexo, before doing DeFi, I started allocating personal funds to Celsius and Nexo, and I realized that I had money I wanted to make yield on. I went to the bank and they offered me 0.15% a year with capital lock for 6 months. I did. It was for my company's funds actually, and I figured, come on, it makes no sense. I knew about Nexo and Celsius giving 8% APR at the time. So I started allocating to these products, and then I wanted to learn how they could generate that kind of yields, and this is how I got into DeFi. And I realized by doing actual DeFi, I could abstract one middleman and actually understand and be responsible for the risk I take, while trusting Nexo and Celsius was less transparent and actually led to losses to most of their users. And not Nexo, but Celsius.
Was that 8% sustainable? Because if you look at, usually the yield is linked to, risk obviously, but there is a yield in the traditional finance markets, right? And if the yield is, or if the interest rate is near zero, how can you have an 8% yield in crypto? Was that possible? Was that all a dream?
I don't know.
There must be a link between both.
Yeah, probably. I guess most of the yield they paid was more of a marketing budget for them to attract users. It wasn't organic yield, and that's something also I learned about while practicing DeFi, is that you always want to understand how the yield is generated, and if it's not organic, it may not be sustainable. So it can be okay at some point, but it will inevitably decrease over time. And can even lead to losses if for instance, the cost of exiting your position is too high. For instance, during DeFi summer, transaction costs on Ethereum were very significant, and you could just lose everything you earned by just exiting your position, for instance. So now I focus more on sustainable strategies because I don't want to overmanage my positions, and I believe that a protocol needs to be sustainable. If it's not about doing just fancy stuff for a couple of months, it's about building the future. So it needs to be sustainable.
You joined the Decentralized Autonomous Organization 2 years ago.
Yeah.
What is a DAO exactly? Explain simply, no jargon.
Yeah, a DAO is just a group of people building stuff together, basically. I guess that's the easiest way to explain. And it could be, if it was in any jurisdiction, it could be a company, for instance, but it's not. Some DAOs are represented legally by a company. Some DAOs aren't, are just a group of people talking together and sharing their skills to build stuff together.
Why would anyone build a DAO instead of a company? What's the logic there? Why is it better? Or what is it better at and what is it worse at?
I guess it's probably more flexible than a company, because there's no legal entity to build. There's not necessarily funds to involve in the first place. You can start a DAO by just joining people on a chat or somewhere on internet, So I guess it's more flexible, and DAO can also offer like a governance mechanism that lets anyone participate to the project. So that can be voting using the blockchain, or without using the blockchain actually. So people can vote and take decisions together and build the project together, basically. And I guess if you want do it with a company, it obviously takes longer to build a company and then to involve new people into the decision making. They need to get shares, for instance, and stuff like that, which is not the case in DAO. For instance, on Aladdin DAO, you don't even need token to be involved. If there's any voting, you need tokens to vote, but you can just pop into the Discord and share your ideas, and your ideas are heard and discussed. And this is how I started, actually. I heard about I've been following Aladdin DAO since the first protocol Aladdin built, which was almost 4 years ago. And when I heard about the latest one, which is FXUSD protocol, I had ideas that I just shared on the Discord. And the team at the moment said, "Oh yeah, that's a good idea. Why don't you do it?" And I did. And this is how ideas after ideas, I shared other stuff, I did other stuff, and I got involved more regularly on building the protocol.
You just mentioned Aladdin DAO. You joined a DAO called Aladdin DAO.
Correct.
About 2 years ago. What is Aladdin DAO?
Aladdin DAO started as an investment DAO. Just people investing together into projects. But very quickly, they realized that some core protocols were missing. Like there was protocols they would like to use that weren't existing at that time. So they started by creating a first protocol. So they pivoted from an investment DAO to a DAO that actually builds protocols. And so it started with Concentrator in 2021, I believe. Then a second one called Clever, and finally FXUSD in 2023, which is when I joined.
Why did you decide to join Aladdin DAO?
Because in everything they did from the beginning, I could see some very strong, like the Ethereum Foundation called the term DeFi punk recently. I don't know if you read about this, but there's very strong DeFi punk values, and this is what I liked. So the idea is that
what are DeFi punk values?
In my opinion, it's all the core blockchain values, which are decentralization, transparency, trustlessness. Mostly, I guess. And as I've been following DeFi and blockchain for the past years, I see more and more centralized projects being released, which is fine. It's probably necessary for massive adoption. But at some point, if there's too many of them and not enough decentralized alternative for the different products, then we lose the core values of blockchain in the first place. Because blockchain is about decentralization and transparency, right? And so there's always been very important shared DeFi values, DeFi punk values in what Aladdin built from the beginning. And I figured if I wanted to get involved with one project, it should be a project with these values that I share. And yeah, this is why I decided to join and to contribute. And the sparkle that made me actually contribute was how innovative was FXUSD protocol.
Let's talk about these core principles, these strong DeFi values.
Yeah.
From Aladdin DAO, you told me 100% on-chain execution.
Correct.
No human intervention, trust assumption. How can you prove it's all happening on-chain?
Oh, because since it's on-chain, you can just look at what's going on chain. And the contracts are published and verified, audited. You can just look at what's going on. It's transparent.
Complete code auditing for every line published.
Correct.
How do you practically make sure every line of code published is constantly being audited?
You can just verify what's been audited by looking at the audit reports and compare it with the verified contracts on Etherscan. So to make it maybe less barbarian, you can just look at the blockchain and look at what code is running on the blockchain, basically. And you can just compare that code with what's in the audit reports. And it may sound obvious because most projects claim to be audited, but many projects sometimes just make a minor update and think it's minor enough so that it doesn't require any audit. And in most exploit cases, it was because of these kind of mistakes. And what I liked also, you asked about what I liked about Aladdin DAO, is how rigorous Aladdin is about security. It's a massive cost. Like auditing is very costly, but still, and without being backed by any VC, every line of code is audited. Even if it's just a minor upgrade, it's audited again before going into production. And this is how, after 4 years and 3 different protocols, there was no major incident, no exploits, and so on.
How do you ensure there is this almost kind of near real-time auditing process? You told me like you have a kind of smaller auditor doing like regular auditing, and then you have a bigger one every now and then.
Yeah, correct. We work with a research firm actually called SegBit, which was founded by one of the recent new advisors of the Ethereum Foundation. And they do all the updates audits, so all the recurring audits. And once in a while, we hire a big name in auditing. So we've been working twice with Trail of Bits, and we've got an ongoing audit with OpenZeppelin, which are probably 2 of the biggest auditing firms around. So they can reassess the whole code. And FXUSD has been already audited 12 times, and there's 2 new ongoing audits. So that's going to make 14 audits in just 2 years.
No VC backing, no team allocation.
Correct.
So no team token allocation. Why is that so important?
It's also what attracted me to the project, because when there's no team allocation, when there's no VC backing, it's long-term oriented team. And so it's not about making quick money. It's about building stuff that lasts. And it makes a lot of sense to me. So it means like what we call team allocation in most crypto projects. When you look at the pie chart of a token distribution, there is 10 to 20% of the token allocation, which goes to the team. It's some kind of a golden parachute for the team members. And there's no such thing at FXUSD protocol or any protocol built by Aladdin DAO. It means the team members are really committed to building in the long term, and same with VC backing. In many crypto projects, the VCs are dumping massively on the retail, and it hurts the project. It hurts the token because people associate the product with the token, and if the token dumps and has a bad price action, then the product may suffer from it. In that case, in FXUSD case, and in every Aladdin DAO protocols, there is no VC backing. So it's mostly community funded, and community owned and run, since the community is very involved into the protocol's strategy.
You mentioned community.
Yeah.
We talk about DAOs. So we need to talk about community governance structure.
Yeah.
I had both Gavin Wood from Polkadot and Meow from Jupiter on When Shift Happens. Both huge proponents of decentralization and DAOs. But the success of their respective DAOs has been limited. For now. Jupiter even suspended the DAO votes, I think, a couple of weeks ago until the end of the year.
Okay.
Because it was not going into the right direction, right? There is always like the wishes and the good side of things, but then there's the reality.
Yeah, correct.
And I would say like the more people you have involved, especially people who probably understand less, when you talk about community, you talk about token holders, they're not necessarily working for the protocol, but they hold the token and they can vote. And then when you start to show, especially when you start to show a lot of transparency on remuneration, how much you pay people, etc., it can create a lot of issues. How do you make it work at Aladdin DAO?
Yeah, it's a very good point, because for me, in the first place, when you first hear about DAOs, it looks like beautiful, like everybody can contribute, it's transparent, everybody can decide and stuff like that. But as you correctly said, there's the project and there's reality. And in reality, if absolutely every decisions are submitted to a vote, it's very inefficient. And there's a massive inertia that you cannot have when you're scaling a new project, because like a new DeFi protocol, especially when it's not VC backed, it's just like a startup without VC funding. Without VC, obviously everything takes longer, but also lasts longer in my opinion. But so what I like about Aladdin DAO is that most very strategic decisions are submitted to a vote, but the rest is decided by the core team. And all the day-to-day decisions are made by the core team. But if there's any strategic decision that would change maybe the perceived values of the protocol, or that would change the risk profile of the protocol and stuff like that, there's at least a discussion in the Discord, or even a vote. And it's, in my opinion, it's a good balance between the fully community-directed stuff, such as Aave, for instance. On Aave, everything is submitted to a vote, and the vote triggers the new code to be implemented. So it's 100% on-chain. But every decision takes just a while. And it's beautiful that they managed to become the biggest DeFi protocol, reaching $50 billion TVL, which is amazing. But it's obviously it takes longer. And when you're a small project, you need to be more agile. And in my opinion, what we figured is a good balance.
Yeah, you need the leadership. If you don't have the leadership, it doesn't work. How can DAOs work at scale when the community becomes really big?
If we look at the Aave example, what they did at some point is they hired contractors. So different companies that are hired for a determined period, and the DAO decides to hire people and give them responsibilities for the day-to-day management. So they have two different risk creators. They have the ACI working, I guess, mostly on the strategy and stuff like that. They have someone, Token Logic, working on their stablecoins growth. And in the end, it's just like having this DAO, which is some kind of a holding, some kind of a big company, hiring different companies. And I guess it's a good example of a successful scaled DAO. So at some point, it's probably something we'll shift towards, I guess. But we're still small enough to keep going like that.
We are here to talk about a protocol.
Correct.
You call it F of X protocol, right? Not FX protocol.
You can call it FX or F of X, as you want.
Okay, let's simplify that for the people who are not aware about the protocol.
Yeah.
What is FX protocol if you had to explain it to your mom?
If I had to explain it to my mom, okay, FX protocol. So I explained what a DeFi protocol is. FX protocol is a protocol that offers two main products. The first, let's start with the easiest one. The easiest one is a stablecoin yield strategy. So it's just like a savings account on the blockchain, earning yield USD denominated, basically. And the main thing is that it's organic and sustainable yield. The second product...
Let's talk about the first one first, and then
Okay.
we'll talk about the second one later.
Okay.
Can you explain what happened in early 2023
Sure.
and how it prompted you guys to build a decentralized stablecoin?
Yeah.
Offering
sustainable
yield.
Yeah, so that stable strategy is powered by a decentralized stablecoin that we create called FXUSD. And yeah, in March 2023, the Silicon Valley Bank collapsed. And it led USDC, which was and still is the main stablecoin used in DeFi, to lose its peg to the dollar, reaching something like 84 cents or something like that.
Do you explain just why the Silicon Valley Bank collapsed? Because it's all very linked to these kind of DeFi values of transparency.
I don't exactly know why the Silicon Valley Bank collapsed at that time, but yeah, if we go back to the transparency values, USDC is the most used stablecoin in DeFi, and it's fully centralized. So when you hold a USDC, you trust the emitter, which is Circle, to actually hold $1 worth of assets in a bank or whatever in their balance sheet. So you trust them. So and the only way for you to know if they actually have it is for them to be audited and for the auditor to do its job correctly. And they don't do they do maybe quarterly audits or something like that. While when you hold a decentralized stablecoin, you can just look at what's going on Onchain at every block if you want. So every 12 seconds, you can just look at what's going on. And so you cannot get better transparency on the reserves than a decentralized stablecoin. So yeah, back to what happened in 2023. USDC depegged, and Aladdin DAO at the time had already two protocols and a treasury, and the treasury was mostly exposed to USDC. So the Aladdin DAO figured it's such a nonsense to work in DeFi on Ethereum, which is the most decentralized blockchain, and blockchain abstracted trust from financial products and financial activities, but still the most used stablecoin and the most so-called reliable stablecoin is totally centralized and can just collapse at some point because of what happens in TradFi. So they released the first white paper of FOX protocol V1 quickly after the March 23 and released the first version in August 23 in order to solve that, because there was and there still are some other decentralized stablecoins, but most of them are not reliable enough, mostly peg-wise. So in most cases, when you need them, the peg is slightly above one, and when you need to get rid of them, the peg is below one. So it's not reliable enough. So we needed to come up with something more efficient.
Yeah, so just for the Silicon Valley Bank story, I think simplified explanation is that when the rates were so low, 2019, 2020, 2021, most of the institutions exposed themselves to long duration bonds because the interest was slightly higher. And so they put a lot of their clients' money in those to earn a bit more, because the longer the duration, the higher the yield. And so when the Fed raised the rate super quickly, then all those bonds, because if the yield goes up, the price of the bond goes down, all those bonds were underwater. And so probably a lot of institutions were actually, probably still are, but were massively underwater. And the problem is when customers start to realize, oh man, actually there's not enough money there if I want to withdraw, and then you have this bank runs, right?
Yeah.
And it's what happened. And the irony is that, as you said, right? The irony is that USDC had, I don't remember, like 5 or 10 or 15% of their reserves in
like
there.
14% or something like that. Yeah.
And the one stablecoin, or I would say the one out of two stablecoins that we thought would never have an issue, had issues. And it was like, it was crazy. It was a crazy weekend. Oh my God.
I was in the plane I was going to the Philippines or something, and I stopped in India, I believe, or I don't remember. Just looked at the price and got back to the next plane, and I had no idea what would go on during the flight. That was crazy.
So you guys reacted and said, okay, we need to build another stablecoin that is decentralized, because obviously, as people have been saying for many years, we cannot have decentralized finance without a decentralized stablecoin.
Yeah, that's right. There's a huge need in stability on chain as well, and as a matter of fact, the stablecoin market is booming. It makes ATH after ATH. It's something like $260 billion now, and so there is a massive need of stability and yield on stablecoins. But most of the new projects are very centralized at the moment, so there is a need for decentralized stablecoin as well.
What's the key difference between FXUSD, your stablecoin, and a stablecoin like USDC? Explain simply.
Yeah, the main difference is that you don't need to trust anyone to hold to the assets backing your stablecoin. You just have to trust the code, and the code is massively audited, and everything happens on chain, so you can even just monitor it yourself. If you don't know how to monitor it yourself, you can even use services monitoring for you, and you don't have to trust anyone. Trust the code and the blockchain.
That's one of the differences. The other difference is the yield.
Yeah,
I can get on FXUSD. What's the yield I can earn on FXUSD?
So the yield fluctuate over time, obviously, but the average yield over the past 3 months is close to 10% APR.
How does that yield compare with other yields and stablecoins in the industry?
USDC doesn't have any native yield to start with. And to compare with the other yields in the industry, if you compare with the other yield-bearing stablecoins, it's been the number one since over the past 3 months. You can just look at another yield-bearing stablecoin project created a very nice dashboard to compare all these yield-bearing stablecoins. It's called stablewatch.xyz, if I recall correctly. You can just compare the different stablecoins, and you'd see that FXSave, which is our yield-bearing strategy, is number one. And the main difference with the other ones is that, as you correctly said earlier, there's no human execution risk. There's fewer trust assumptions because it's 100% on-chain. And so in my opinion, it not only gives better yields, but also lower risks.
There's no yield without risk? Where does the yield come from on FXUSD?
To explain where the yield comes from, it's probably a good moment to explain what's the second product to my mom. So I explained about the savings account and the decentralized stablecoin. The decentralized stablecoin is created, is a byproduct of the second product. So the second product is a leverage product. So to explain it simply to my mom, I would say that it lets user get enhanced exposure to an asset. So that's it. This is what we call leverage exposure. In most cases, when you want to get leverage, overexposure to an asset, the way it works is that if we take the example, the way it works is that you usually borrow a stable coin or fiat currency so that you can buy more of this asset. And when the price of the asset appreciates, then you can sell fewer than what you bought to repay the debt that you borrowed. It's exactly what most people are doing when they buy their houses. They don't have the money to buy it, and they believe that the real estate will appreciate over time. So they're actually leveraging real estate when they buy their house, because they get a mortgage at the bank and a loan at the bank, and so they will borrow money so they can buy the house. And once they sell the house and with profit, they can repay the loan. And even if the loan costs them a lot, they're good with it because the price of real estate appreciates. So, yeah.
Yeah. So this leverage product basically enables the protocol to create fees that's going to help generate this yield.
Yeah. So the leverage product is very unique because it offers people to get up to 7x exposure to Ethereum and Bitcoin without paying any borrowing costs. Instead, they just pay a one-time opening and closing fee. So it brings predictability to the leverage cost. And we also have a very unique liquidation mechanism that prevents any hard liquidation. So it's some kind of a zero stress leverage. And I'll probably dive deeper into this later. So the users, the leverage users, pay this one-time opening and closing fee. And this is what generates the yield for FXSave.
Okay.
Mostly.
Let's get into these two kind of twists of what FX protocol offers.
Yeah.
A bit later, but first, why isn't everyone using FXSave if the yield is better and if it's fully decentralized?
Why isn't everyone using it? Probably because FXSave FXUSD is fully decentralized. FXSave is powered by both FXUSD and USDC. So when you stake into FXSave, you have exposure to both. But why isn't everyone using it? Probably because of awareness. But there's already a pretty decent amount of people, or at least money, using it because there's something like $60 million in FX in the strategy. FX, So, and it's growing. Like the protocol crossed $270 million value locked organically in just 7 months. So it's very nice growth.
So there's currently $60 million in this FXSave product generating about 10% yield. A year. To be correct, there's 45 in FXSave, but FXSave is built on top of what we call the stability pool, and the stability pool has something like 60 million. What's the risk with your stablecoin? What could go wrong?
So the risk of the like every stablecoin, is to lose its peg. So we're talking of other examples in the past that went to zero, and that's something you definitely want to avoid. And for it to lose its peg, it would mean that the backing, the value of the backing goes below the value of the circulating stablecoins. And the protocol has many different mechanisms to prevent this from happening. The first one is the liquidation protection mechanism I told you about earlier. It protects the backing by liquidating the leverage positions very progressively so that they hopefully never get hard liquidated. Let me know if you want me to explain what liquidation is, maybe.
Yes, that's one of the questions. Basically, we can get now into the kind of two twists, right?
Yeah.
Of FX protocol in terms of trading on leverage.
Yeah, and then I can maybe go back to the different peg keeping mechanisms.
So the first one is, let's talk about funding fees.
Yeah.
Right?
Yeah. The first twist is, no borrowing costs, no funding fees.
So no ongoing funding costs, right?
Yeah, correct.
What is a funding fee?
A funding fee, in most cases, when you take leverage, you either pay a borrowing cost, because as explained earlier, getting leverage, in most cases, it's taking a loan. Or you pay your funding. So funding cost happens on perp protocols, so perpetual futures, and the longs pay a fee to the shorts, and the shorts pay a fee to the longs. It helps. It's made to balance the demand between longs and shorts, basically. And in some cases, the funding cost can reach like 100% APR. So it definitely eats your profits massively. People sometimes don't realize it because they're making good trades. So the underlying assets is giving good performance, but still they paid 80%, 90% APR on to hold their position. And
is it only affecting your profit, or is it also affecting your collateral? Which means that if you stay kind of underwater, or if you keep the position open for too long,
like
your
if
collateral
you're
can kind of disappear.
if you're making profit, it eats your profit. But if you don't close your position while you're at profit, and your position goes back at break even or even in losses, it just increases your losses, and or you can create loss while you should be at break even, and even eat your collateral, obviously. Yeah.
How do you guys innovate and remove the ongoing funding fees?
We remove it by not being a perp, basically. And we're like, if you know about the different designs to create leverage, there's perp protocols, and there's what we call collateral debt protocols, or collateral debt positions, or CDP. And FXUSD is closer to CDP. The first CDP, the first well-known CDP, was Maker with DAI. Today, DAO is not a CDP anymore. It's or at least it's backed mostly by USDC. It's a similar model, but the initial CDP model was limited in capital efficiency and couldn't scale, and would have difficulty to keep a good peg. And this is how FXUSD innovates, by being way more capital efficient and with a better peg keeping mechanism.
What's the difference for a trader to pay an upfront an exit fee instead of an ongoing fee?
It brings certainty. You know exactly how much your position is going to cost you, and if you know that you will hold that position for long enough to compensate for the one-time fee, then your position will be very, very cheap to hold, basically, to compare with a perp position, for instance, in which the funding cost can just spike at some point. No, so it brings certainty.
The other twist is minimal liquidation risk.
Yeah,
we kind of talked about it a bit before, but
yeah.
how do you do that?
Yeah, so maybe let's explain what a liquidation is. So when you take leverage, you bring a collateral to secure your leverage position. Today, there's in real life, you can get a loan just on your reputation. It's not the case yet on chain. So to get a loan, you have to bring a collateral to secure your loan on chain. And whenever your debt the value of your debt is too high to compare with the value of your collateral, this is what we call the loan to value. When it reaches a certain threshold, your collateral can be sold to repay your debt, so to protect the solvency of the protocol. This is what we call a liquidation. In most DeFi protocol, liquidations will liquidate 50 to 100% of your debt at once, just to make sure they get everything repaid. It's very painful, because the user experience of being liquidated is just like closing your position, so selling at the market in the worst scenario. So in most cases, when the market crashes, and you're just selling at the worst price, and if the markets rebounds after crashing, you don't benefit from the market rebound. And so the way we minimize the impact of liquidations is by basically liquidating just the smallest portion of your position to keep the maximal exposure of your position. So if I go more, if I go deeper into the technical terms, so that whenever your loan to value crosses 88%, the protocol puts it back at 88%, so that it never reaches 95% hard liquidation. The hard liquidation means the rest of your debt is repaid.
Let's take an example.
Yeah.
I use Bitcoin as collateral.
Yeah.
And I want to get a loan on. Let's take some random Bitcoin value. It's going to be easier. I want to get a loan of 50K. So, and let's say the loan to value is 50%. Would that work? And so I need to put Bitcoin worth 100K of Bitcoin in there. And so if basically the principle of liquidation is if my Bitcoin value goes down by 50%, then I'm going to be fully liquidated.
Yeah.
What's an example we can take here to understand better the way you minimize these liquidations?
It's not easy to put numbers like that out of, especially just without any paper. But I have. How could I make an easy example? So. Basically, if the value of your Bitcoin decreases too much to compare with what you've borrowed, even if it's not exactly borrowed, but to the value of your debt, then we'll sell your Bitcoins dollar per dollar. Basically, we can't do that profitably, and that's the innovation in FOX. We just sell a very tiny portion at a time of your Bitcoin to repay your debt, so that you don't reach a very dangerous threshold for the protocol, which is 95%. If that process doesn't work at some point, and that your debt reaches 95%, the value of your debt reaches 95% of the value of your Bitcoins, then we sell the rest to make sure the protocol remains solvent. I'm sorry.
But if there's a flash crash, for example.
If there's a flash crash. So these numbers, so the 88 and the 95 doesn't come out of nowhere. We looked at all the past volatility of Bitcoin and Ethereum, and there was no flash crash that could have prevented this from working correctly in the past. So if Ethereum and Bitcoin are less volatile over time, which is with adoption should be the case, but we never know, then it should work correctly. But when you build a DeFi protocol, you always have to anticipate what could go wrong. So this is why there's the first layer, which is the liquidation break. So putting back your position at 88% LTV. If it doesn't work, then there is the hard liquidation. When you reach 95% LTV, the whole debt is repaid, just as on any other protocol. But on the other protocols, it happens at in most cases around 80% LTV. So it happens way sooner. To give an easy example, using any other DeFi protocol to get your leverage on BTC, let's say BTC right now is around $115,000. I'll just give random numbers, right? You would get 50 to 100% of your debt repaid on another protocol when Bitcoin reaches something like $100,000, while on FOX you would start to be liquidated when it reaches maybe 90, and progressively liquidated over time if Bitcoin value still decreases, and if it recovers, you recover with it.
Clear. The audience will probably go have a look at CoinGecko, and we'll notice a circulating market cap of just $6 million.
Correct.
Can you explain why?
Yeah, of course. First, the token has no VC backing, so there's no VC chilling the project everywhere and so on. It's always important to look at how the circulating market cap is done on CoinGecko. They don't account for the locked tokens. FXN, which is the governance token, is a V token. So it means stakeholders can decide to lock it up to 4 years to get voting power and to get revenue sharing. And so the circulating supply doesn't account the locked tokens. As a matter of fact, there's a very big amount of tokens which are locked for an average of 3.5 years or something like that. So they will very unlikely be sold. And so this is why CoinGecko doesn't account them into the circulating supply. But actually, I believe there's close to 50% of the supply is already circulating, but most of it, like 70% of it, is locked for a long period of time. An important fact about the supply as well is that 30% of the whole supply will go to Aladdin DAO. And Aladdin DAO always revest it, so relock, or max lock it for 4 years. So this 30% will never be sold either. And there's 49% of the whole supply that goes as liquidity incentives. So it's basically yield to attract liquidity for the different strategies, on-chain strategies, and they will be distributed over 50 years. There's 48 years remaining. So the dilution effect is very low, and it's going to be fully emitted in 48 years, basically.
What's the one thing that listeners should remember from this conversation?
I think the one thing to remember is that we build things differently, and we build transparent and fair thing for users. Like the mantra of Aladdin DAO is building secure and secure and wait, let me find it. I think it's building secure and transparent finance with a touch of magic. And this is what I like about Aladdin DAO. There's always a small stuff that makes the whole difference with the rest of DeFi. And with FXUSD, it's about building some zero stress leverage and sustainable decentralized yield strategy. And there's nothing else like that in DeFi. And this is what I like about FXUSD.
Thank you so much, Cyrille.
Thank you. Thank you very much. It's been a pleasure.
For this great conversation and for giving us some hope that there is some people who are here in it for the long term. Yeah,
we are.
Game.
We are. And there's others, but Aladdin has always been about building in the long term.
Amazing. Thank you.
Thank you very much.